Hello class. Our group consists of Dwayne Rollins and myself, Nicandro Delgado. Our topic deals with the uncertainty of a consumer while making an economic decision. During any decision, there are no guarantees that a particular outcome will occur. This is true in everyday life and in economics. However, we can take a calculated approach towards consumer behavior and the firm's behavior. In particular, we will be focused on the consumer behavior in the marketplace. We can do this by averaging the different possible outcomes and multiplying it by the payoff. This will give us a mean, or the expected value of a particular decision. The equation is shown below, right here. In this equation, Q is equal to the probability of that particular outcome happening, and X is the possible outcomes from a decision being made. The expected value is useful. However, it only calculates the average of the possible outcomes. It does not take into account the risk that a particular decision will have. In order to know how risky a particular decision will be, variance becomes very useful. The equation to calculate variance is shown below, right here. The variables in variance are similar to the variables in expected value, where Q is equal to the probability of that particular outcome happening, and X is the possible outcomes from a decision being made. In variance, we also have the EX, which is equal to the expected value that we calculated earlier. Once a consumer knows how risky a particular decision will be, the consumer can decide whether to take on high risk, low risk, or they could be different in regards to risk. These attitudes are formally known as risk-averse, risk-loving, and risk-neutral. Dwayne will talk more about risk in a minute. Expected values and variances are useful when the price is known. However, when the price is unknown, the consumer will need to search for the lowest price. This is where reservation price comes into play. The consumer can either take the price given or decide to search for a cheaper price. The problem is that with each additional search, there could be a higher cost. We will discuss this topic in further detail later in the presentation, where the consumer will reject a price at a given price and cost, or reject a price at a given price or cost. This is determined by where the consumer feels comfortable or indifferent about the price that is offered. This is also called the reservation price. During this presentation, we will also cover the graphs dealing with attitudes towards risk and the graphs dealing with consumer search. We will cover these graphs in greater detail by Dwayne and myself. Along with the graphs, we will also discuss the real-life applications of the topics we discussed in this PowerPoint, such as the risk and the consumer search.
As Nick mentioned, consumers have different attitudes towards risk. When we speak of consumer in this presentation, we want to relate it more to an investor. As you know, investors provide money or resources for different assets. Thus, he's a consumer who is buying an investment that he wants to see what financial or other gain he can get from his risk. So first, let's look at risk averse. In economics or finance, it's based on the behavior of humans while exposed to uncertainty to attempt to reduce that uncertainty. Now, to explain that somewhat more, imagine there's an investor who chooses to put his money into a bank account with a low but guaranteed interest rather than into a stock that may have high expected returns but also involves a chance of losing value. So what you have here is someone who's actually trying to play it safe. So rather than investing into some new company where he can access a 10 or 50% gain, rather he tries to avoid that risk and goes to the bank where he shows over 1% on his return. Now let's move and look at a risk neutral. These are people who are not affected by the degree of uncertainty in a set of outcomes. So what they do, depending on the choice whether it's risky or not, they play it safe. So what will happen is that an investor will invest exclusively in an asset with the highest expected value. So this investor is one that, despite the risk, he's gonna see where he can maximize his money, and he's gonna go all in. Third of all is that risk-loving person, a person who has a preference for risk. In economics and more consumers, this is very hardly, what I would say, you'll hardly find anything of this sort. Because what happens, they acquire investments of high risk with a low expected return. And as I said, very rarely would you see something like this happen. So now let's look more at a mathematical or graphical representation of how we describe these attitudes towards risk. Now, before we stress, I want to specifically talk about what we call a certainty equivalent, which is going to be represented by that green dot. The expected value of that utility. All right, this is what a customer expects he's going to get, what his risk is worth. And then the actual utility of the expected value for that uncertainty payment. So these three dots are what we're going to really highlight a lot when we talk about this. Now if you look at our graphs, the x-axis is talking about the utility, or actually your payment, or how much they're willing to put in, and the y-axis talks about the utility or the value. So anytime you're going to get what we call a concave graph, you're looking at a risk-averse consumer. Now, in this risk-averse consumer, you'll realize that his utility of his expected value is actually higher than what his expected value was. So the actual utility, which is this blue dot, is higher than the certain equivalent, or what we'll call that's the certain equivalent, and also the expected value. So in this risk-averse consumer, he's taking very little risk. He's opposed to taking risk. So he's actually getting a higher value, or something that is quite sure, because you see, he's actually sure what he's going to get over what his expected value could be. Now let's move on to someone who's risk neutral. Now you're going to see that you have an actual intercept of all 3 points: his expected value, his certain value, and his actual utility. It's all there for a risk neutral graph. Finally, we have the risk lover, the person who is willing to take the risk despite what's going to happen. Now, if you look at this, you realize that his actual expected value is lower than his certain utility, or the expected equivalent. This is someone who's willing to just gamble because they have the money. This is for more of the rich. This is someone, I'll tell you, I can give you $100 if you just come, or you can gamble opportunity to get $100. So we have the risk loving, the risk neutral, and the risk averse. We can even stress more into detail if we were to look at a mathematical term, where if we were to take the tangent to the point on the graph, where the second differential, if this was less than 0 of that tangent, or you were to take the second differential of this curve and you get less than 0, you'd be risk averse. If you have a linear graph, then you'll be considered risk neutral, and the opposite of risk averse is if you have this convex curve, you will be considered as a risk loving person.
Like stated in the introduction, there are times that the price is unknown. When this occurs, the consumer will need to search for alternative prices and decide whether they want to accept the price or continue to look for an additional price. Let's first look at Figure 1 labeled Optimal Search. In this figure we have EB, or expected benefits, which means that once a price is known, the probability that searching for a lower price decreases. This is why expected benefits slopes upward, meaning that the more we look, the less likely we will find a better price. Instead, the benefits of searching will just continue to diminish. In this graph, we also have cost and price. As cost and price go up, the consumer will reject the product or service. However, if the cost is lower than the reservation price, then they will accept the product or service. The reservation price is a price that the customer is indifferent about purchasing. Now let's take a look at what would happen if the cost of searching for an alternative price would increase. Let's take, for example, I am searching for a particular appliance. Now let's say that while I am looking, the price of fuel is significantly increased. In the graph, increased search costs, it is denoted by C, and then it goes up to the green line. In this case, I would be willing to pay more for a particular appliance that I could find in the area, and I would look more intently at the current offering than driving to multiple locations trying to find a cheaper price.
So to wrap it all up, let's conclude all that we've discussed so far in our report. A risk aversion is the most common attribute of consumer behavior in the market today. Now you may ask why. This is simply because of the reluctance of a person to accept a bargain with an uncertain payoff rather than another bargain with a more certain but possibly lower expected payoff. And that is why clearly today the market can be described as a highly uncertain business environment. And with all these high uncertainties, most companies are trying to be, and consumers and investors are risk averse. They are willing to be sure of their expected outcome and rather than to take that risk not knowing where the market is going to drop. And we can even go and say that in other economic, in gambling, in the way consumers purchase, as Nick mentioned, whether you're going to invest in Google, whether you're willing to drive to buy something, that is where we're seeing the more risk averse customers. If we move on to the utility maximization, now we all want to get that high payoff, so everybody wants to go all in. But basically, there are a lot of things that we have to consider. Most of all, we must consider the opportunity cost. The opportunity cost is key. But either way, utility maximization is the ultimate goal of all humans. Now, one key aspect that we haven't mentioned much is what we call asymmetric information. Very key in risk and very key in making decisions. So here, if we have two parties in a transaction, it could be investor and the person investing in it. It could be the consumer who's going to buy some milk from a grocery store. It doesn't matter. If one has better info than the other, then basically one has the opportunity to reduce his or her risk and exploit the other. So having this information helps to avoid risk, helps to make consumers make better choices in their economic decisions. However, if this risk is not controlled in the economy, this can lead to market breakdown. So what we find key is that information is going to play a vital role in the market and in the economic decisions of the consumer. That is why today so many companies invest so much time and money in getting information, doing surveys, doing market reports. So this favors both consumers and managers and firms as well. However, the one good thing about the introduction of the internet is that the internet has led to reducing the cost of getting this valuable information that has helped making economic decisions in the market today. So finally, all else equal, no one likes risk or uncertainty. So in today's consumer world, where we speak about uncertainty and consumer behavior in economic decisions, the goal today is to avoid risk, is to make decisions that will provide your maximum outcome with as little risk as possible. And that is why today, from our conclusion, we can conclude that our market is filled with risk averse consumers.